Today, I'd like to give my thoughts on the Fed meeting now that Fed Governor Bowman has spoken. But first, let's think about what the Fed's faced over the last, let's say, 4 years, okay? First, we had a global pandemic, the first since the 1920s. We had our first European war since the 1940s. We had our first energy crisis since the 1970s. We had our first banking crisis in, 15 years, okay? So just those events alone would make being a Fed governor a tough job. But also remember something. When we hit COVID, we then put on $6 trillion onto our balance sheet. So we went from 3 trillion to 9 trillion. We're now 7 trillion. Okay, so we came down 2. Also, we passed several historic acts. First ones, of course, being for COVID, and then the Infrastructure Act, and then the CHIPS Act. Now, these are recognized as historic acts for what they're trying to accomplish, but also the size of them. So when you have all this liquidity coming into the market, and then the Fed starts making its decision, I would say overall, without knowing all the insides and everything, it seems like they've kind of navigated this pretty good so far. How's it all going to end? Well, it's still open to question. Okay, so at the last meeting, we know they cut by 50 bips. And to stay with the historical in nature, the 50 bip initial cut is also historic. Normally, it's 25 bips. Now, when Powell came out and spoke, everyone knows what he said. To me, everything was hunky-dory. They're doing the 50 for the employment, and they feel inflation is on its way down, okay? So that's generally the narrative. Now, there's a side narrative to this because a lot of people can't explain the 50 bit cut, including myself, because I go by the numbers. But there's a narrative now that the economy is in far worse shape. Unemployment's going to skyrocket, and the economy is going to bottom out, and we're going to finally have that recession, which again, by the way, we had an historically long inverted yield curve, okay? So here we are now, and we know in that meeting, I'm not a Fed watcher, but I saw one of them say that Powell, quote unquote, herded the board to 15 people to vote for the 50 bip cut, and Bowman still stayed out, okay? And so Bowman went down to Kentucky to speak to the Bankers Association, and this is what she had to say. After some pleasantries, she says, she agrees with the board that with cooling inflation and with some softness in the employment numbers, it is time to begin to reduce our rates. She just felt it was a quarter point, not a half a point. Then she goes on, I think it's interesting to note, she's very specific on her numbers and where she gets all her information from. I would say it must have been very interesting in that board meeting. But anyway, you can stop and read this. She talks about the labor market and where it's been and where it's going and what she sees. And I think it's pretty obvious that she feels that the employment numbers are at historic lows, even though they're off the low lows. And she sees no reason for this to be a reason to lower the interest rates by half a point. And she also mentions, which I am so glad because I certainly believe that this is a major issue, is that, a lot of the inflation went to 9%, everyone says was the supply chains. And yet, we've kind of like dismissed it. It's all over and everything's hunky-dory with the supply chains. I don't see it that way. In fact, are there any ships going through the Red Sea? I mean, that is the major supply chain route of the world, okay? So we still have a very fragile supply chain. And if the supply chain goes down, do we go right back to 9% inflation? I don't know. You have to answer it for yourself. And she also states that even though the inflation rate remains around 2.5%, it's above their target of 2%. And I'm kind of confused here because didn't the Fed last year say our target is now 3.5%, and we're at 3.1? But again, what she's saying here is we really haven't hit our inflation numbers. Okay, now Bowman goes on to 4 reasons why she felt they should have stayed at quarter point. The first was she believes that if they cut by a half a point, that the market would read this as there's fragility in the market, in the economy. By the way, we are. Second, by reducing a half a point, the market could interpret that to they could expect more half points or 3/4 points. They are, okay? Third, the pent-up demand with cash on the sideline. I mean, in the money market funds, I think they're at $7 trillion on the sideline. She's afraid if we indicate this, we could send all this money in, which would be highly inflationary. And finally, she goes, the neutral rate. Now, this is where I think the big discussion is going to be. What's the neutral rate? The neutral rate is when the Fed sets the interest rates so they're neither restrictive or expansive, okay? It's neutral. So the discussion that's going on in the Federal Reserve is this. Is the neutral rate the same as it was pre-COVID, or is it now at a higher rate? So we can see she was not a believer of our inflation, okay? The second thing is what she looks on the economic outlook, which I find very fascinating. So she follows something else, and it's called the, so if you go down to paragraph 3 here, she follows what she calls the private domestic final purchases, okay? Instead of GDP. She works these two together. So what is this PDFP? So private domestic final purchases are an important economic indicator that measure the spending of U.S. residents and businesses, excluding government spending and inventory changes, okay? So you could have an inventory change, which has nothing to do with the GDP, could lower the GDP or make it higher, okay? So what they do is they strip that out. They strip out the government. There's a lot of people out there in my comments who think that the economy is only where we are because of the government. But by following the PDFP, this is what she found. First off, if the PDFP grows faster than the GDP, it suggests strong domestic private sector demand. Obviously, if it's slower, it indicates that the government spending or net exports are playing a larger role in economic growth. So for the second quarter of 2024, PDFP rose by 2.9%, following a 2.4% increase in the first quarter. This growth outpaced the overall GDP growth of 1.6%. So the PDFP is showing that the underlying economy is much stronger than what the GDP says it is. So what does this all mean to us, right? Okay, so here's where the disagreement comes down. She believes, Bowman, that the neutral rate for the Fed is now higher than it was in pre-COVID days, which I totally agree with, okay? I could be 100% wrong. So what she's saying, what Powell and the rest of them are saying is, we raised by 5.5%. So remember, that was also historic, the 550 basis points move, okay? So they're saying we were overly restrictive, so we can lower faster to get us down to where we believe the neutral rate is. On the other hand, Bauman's saying, no, our neutral rate is much higher. And actually, that means that we've been less restrictive than the market is saying that we've been, okay? So there it is in the rub. Where do you think it is? Do you think that we have a higher neutral rate today, or is it back to where it was pre-COVID? That's it, right? If you agree with Bauman, they should have only done a quarter point. And if you agree with Powell, you're going to do 50, whatever, and get it down. What do you think? Like and follow, and certainly let me know in the comments.